Good evening, ladies and gentlemen. It is the 12th of March 2026, currently not 9:36 p.m. Just going to go over a quick review of today's trade. Uh, Before we get into that, just want to take a look at the daily chart. As you can see, it's absolute disaster, absolute mayhem. Just very frightening, very ugly price action here. I mean, not much you can do here as far as determining a bias. It's swept sell side liquidity. There's kind of buy side liquidity here and up here. Yeah, mostly unknowns, but it's easier to discern intraday price action rather than long term daily, weekly, monthly price action, especially in cases like this. All right, let's drop down. Let's just go all the way down here. So the trade I took today was not perfect, but it did make sense, and I'll show you how. First, I'm gonna mark out 0830. This was a CPI candle. As you can see, it's a lot more pronounced than the other candles. Just a big wick. 830 opening price. A good trade here would have been using an inversion fair value gap like right here, aiming for this data high. Not terrible, but if you wanted to wait for open or post open because you just weren't, because here you can see we have a failure, a failed attempt of sweeping the previous session's low, so London's low. So for me, that automatically, uh, like for longs, that was like unfavorable for me because it did not sweep London sessions low. So then this kind of became my new target down here. These relative equal lows is what I was looking at. That was my draw on liquidity post open. So you wait, then you get to a point of resistance here. New week opening gap low, February 8th. So you can see that the algorithm refers back to just about a month or 5 weeks. Um, it can go longer, but all you really need is like 5 weeks and up as far as new week opening gaps. You can use new day opening gaps too, but that's way too much for me. I used to do that. It was way too complicated. So here you have relative equal lows. You can just look. So usually I like to go before 7 a.m. and look for liquidity there. Relative equal lows here, here, and here. This is obviously in another day. So you can look that far back to look for draws and liquidity. See, you can see here it's all swept, and there's still more resting here. But for like at this time when I took this trade, a lot of buy side liquidity was swept, and there was a lot of sell side liquidity. And I'm also going to show you why that was a draw on liquidity for me. Jump into the 4 hour. Boom. All right, let's see. So, 1 sec. Okay, yeah, here it is. This is the fair value gap I was using this morning. So you go like that. And when there's an imbalance here like this, like a gap between the bodies, you also include that into your fair value gap. That's the true measurement of the fair value gap because there's still an absence of trading here. It just doesn't look the same as other fair value. Like it doesn't look like this. Or see how there's an imbalance here? So you would measure that from that imbalance to the bottom of this candle instead of the top of this candle to the bottom of that candle. When there's imbalances, you got to include them because it's the algorithm refers to it. And then use something else on the 15 minute. I really only use the 15 minute, the 1 and 2 minute, and the 4 hour. To be honest, what did I use? It was a wick, I think. No, it wasn't that. think it was like a fair value gap or something here. I'm not sure what I was using. It it might have been this fair value gap here. I thought it was a wick though. Whatever. We'll just measure this fair value gap out. It might have been what I was using. We'll see. Gonna drop back down to 1 minute. So this trade wasn't super clean. Oh yeah, it was. So see the 15-minute fair value gap that I measured out is in red. The 4-hour fair value gap is annotated in blue. So now we have relative equal lows in an efficiency, a big inefficiency, and you have price above 0.830. Now what does it do after all that has happened? It creates a first presented fair value gap right here at 943. So that's an entry there. As soon as price hits this, see how it fails to go above consequent encroachment or close above this fair value gap right here, this first presented fair value gap. 930 is only the first presented fair value gap in some rare instances. I forget the criteria, but most of the time you want to disregard 0930 because in regular trading hours, 0929 doesn't exist. So if I go like this to regular trading hours, this is now 0920. This is not zero. This is not 0929 anymore. It's the previous closing price. I know it looks like the same, but that's just because today didn't produce a big opening range gap. But there's an opening range gap, a small one right here. You see that little imbalance. So the closing of yesterday's price and the open of today's price, there's a small tiny one, but that's another reason why this trade wasn't really clean. It wasn't really a higher probability trade. I probably shouldn't have taken it, but uh, I did anyways. So that kind of fucked up today. It did. I mean, the trade 100% worked out, but it just wasn't the trade to take this morning. But it would have worked out fine. And you can see my logic behind this is the 15-minute fair value gap that I annotated here. It fails to close above consequent encroachment or 50%, which is this red line right here. See, it almost reaches to it and then it reacts. So you got to look at the reaction after price action because that it's like a telltale sign. Like if it reacted, not like if it was just like smaller, like shy sell side candle or downside candles, sorry, down close candles, then I wouldn't be convinced that oh shoot that it was going lower. But it reacted with 3 down close candles. So that was the reaction for me at least that it was going to go lower for at least like a couple minutes after that, and then it came back up. Ended up doing one more buy side liquidity sweep. This is called a turtle soup, and then boom, this was like the money trade. But I didn't take that. This inversion for value gap right here. This was the trade to take, especially because it was during a macro. So sometimes you just gotta wait until the opening range is formed, which is from 0930 to 10 o'clock here. We're at the high of the range, it's formed here. And yeah, it ended up selling off a lot from there. But you could have made money on this trade as well. It just obviously you wouldn't have reaped as much. So this is the first presented fair value gap here, and as you can see, it was used as a catalyst multiple times throughout the morning. So not only did it use it once here, bang, it uses it again to propel price up to sweep sell stops, and then it came back down, was kind of like in between all these inefficiencies here, and then displaces off of it again, and then comes back up, and then displaces off lower. So that's the power of the first presented fair value gap. As I mean, you could like kind of say that for other fair value gaps, not really though. I mean, look at how precise it is. Um, but I was looking to take a trade here just because I was rushing. I was like I was pulling pits for a range. So the optimal entry would have been when it strikes here. I didn't get that entry though. My trigger was using this wick, so you can also use the wicks for entries too. So when if it were to stay above 50% of this wick, then I would see that as like, no, it's probably not going to go lower, but see it crushes through the wick, which tells me that it's probably going to go lower. So that's what I use as an entry. But the better entry would have been here, waiting for price to get up into a premium, into this fair value gap, and waiting for it to sell off. But so obviously my draw on liquidity was this low, like these relative equal lows in this fair value gap, in this 4 hour fair value gap. But it didn't take that until later. So timing the market is really difficult, but having a draw on liquidity allows you uh, more breathing room to not be super precise. Because if you have a good draw on liquidity, then you could take a trade and it'll still want to move in that direction. Even if it doesn't get all the way, you can still be profitable in the trade. As you can see here, instead of sweeping all the liquidity, all it did was hit this order block that was formed uh, previous day. Oh, I'm in regular trading hours. Let's go back to electric trading hours. Pretty sure it does the same. Yeah, so you can see here, it strikes this order block that was formed here, and then it propels higher. And you can see this order block, how it doesn't close below 50% of this order block, meaning that it's strong, and then it displaces, and then boom, you're gone. You get more buy sides, or sorry, sell side, sell stops, sweeps, and then it gives the ghost and goes way low into the 4 hour fair value gap. So that's just kind of what I used today. Like I wasn't looking for longs really at all. The only long that would have been good to take would have been at 0.840 around here, but even then it wasn't really high like probability because it didn't sweep this low right here. Yeah, that's it. That's what I do. So you just got to stack all these. So like the 15-minute fair value gap, the new week opening gap low, the reaction off of that. What did it form? A first presented fair value gap. So you can use all these things. And it's also above 0.830, and there's also a huge draw on liquidity here. It also just sweep buy side liquidity, a bunch of it. So it's all about stacking the odds in your favor. And if you can do that well enough and not, and you, even if you do that, sometimes you're gonna get ran through anyway. So if you can do that and just stick to it and be consistent with it, I think there's success to be found with this stuff. But yeah, that's it. Peace.